Okay, so reading 51, fixed income markets for government issuers. Okay, fixed income markets for government issuers. Fine. So government issuers, okay, so government wants to borrow money. So if government wants to borrow money, what are the ways? Sovereign debt, that means debt raised by the government, okay, that is called sovereign debt. Now here, a key distinction in sovereign debt market is the difference between developed market versus emerging market. Okay. Developed market sovereign issuers have stable, diversified economies with consistent and transparent fiscal policies. Debt is denominated in a reserve currency, a major currency held as reserves by central bank across the world. Normally, that reserve currency is dollar. Dollar is considered as a reserve currency. Emerging market sovereign issuers typically have faster growing. So this is the keyword: stable growth, and here faster growing, less stable, and more concentrated economies, and consequently less stable tax revenue. Okay, so more concentrated economies means they are not that open to the world, so it will be little conservative. Why it will be little conservative? Reason being, if it opens its economy to the world, then all cheaper goods will flow into the market, but then they will not be able to grow further then. Okay, so they tend to play little safe. uh, yeah. Okay. Yeah. And then domestic debt or external debt, these are all normal one only. Debt management policy: a government's debt management policy sets out the amount and type of securities the government intends to issue. A government's debt management policy sets out the amount and type of securities the government intends to issue. Okay, so debt management policy, that means how much to be borrowed. Okay, so there will be some policy towards the debt. Okay, like a company cannot keep on, not company, government cannot keep on borrowing. Like in India, we have one policy, FRBM. I don't remember the long form, FRBM, that is there, uh, which discourages government to keep on borrowing recklessly. Okay. Non-government, non-sovereign government debt. So non-sovereign government debt means not issued by the national government. Sovereign means national government. However, issued by states, provinces. Provinces means provinces, and then counties. Counties is district. Okay, in we say district, right? They say counties. Provinces is a region, and yeah. So these are issued by states, districts, and all those for the construction of hospitals, airports, and other municipal services. Agency or quasi-government bonds. Quasi means partial government. What do you mean by partial government? That means government is associated but not fully. They're not fully running it, but they are associated to some extent. For example, the one we saw, remember we saw these government-sponsored entities in mortgage-backed securities. I told Genime, Fenime, that is, this is the one. Genime, G-N-M-A, Genime. Written like this, Genime. G is Government National Mortgage Association, Genime. Okay. That means it was created by the government, right? That's why quasi-government. So when they are issuing bonds, quasi-government bonds. Now these bonds, local and regional government authorities may issue debt for general public. Okay, spending backed by local tax raising powers. Now these are all general obligation bonds and revenue bonds. What does this mean now? Uh, General obligation bonds means, now general obligation bond means here debt is raised, but they will not get any revenue for fulfilling the obligations. So they will get this, they will be paying from the tax that they get. Like for example, imagine you are going to a park and there is a chair where you can sit. Somebody has given money for that, right? So that somebody, let's say municipality in India. So municipalities are maintaining, let's say, parks, gardens, and they are keeping some chairs. So are you giving anything at that time? Most of the time we don't. Or imagine, you must have seen zebra crossing, they will be painting, right? Do we pay anything at that time for taking that service? No. And so like this, many services are there where uh, municipalities are doing the work and we don't pay. Or imagine somebody, or these garbages and all, they come and clean on the road. You must have seen people, scavengers, they clean. So here they need money for all this, right? So that is general obligation towards the society for them. Okay. Or you must have seen government shauchalay. So all those are general obligations. Okay. Then revenue bonds means where they are getting money. Okay. So what is that? Where they are getting money, they maintain certain things, and they charge also. Maybe some park where they will charge. Okay, that is also possible. Or they will build some infrastructure and then like toll road,
Collect
bridge,
toll tax,
toll tax,
all
and they
those
will
things.
charge. There they are getting the revenue. Okay, but in general obligation they don't get. So local and regional government authorities may issue debt raised for general public spending backed by local tax raising power. Okay. Then supranational bonds. Supranational bonds means issued by international institutions such as World Bank, IMF, Asian Development Bank. Okay, all these are called supranational, basically international institutions. Okay. Then competitive bidding and non-competitive bidding. Did I show this to you in RBI Treasury bills? RBI Treasury bills, competitive and non-competitive bidding. Uh, so I'll show it now. See, rbi.org.in. Okay, this is the website.
The
Then
competitive bidding is where like the companies
institutional
they
investors will compete, and non-competitive means quota will be there
quote
for small players. So they will borrow even from the small players.
retail
So
investors.
this is, yeah, treasury bills. So here this one. Now if you read this, you will find all these terms. So here competitive and non-competitive. See this one. And non-competitive means quota system, where for smaller players they will borrow money from the smaller players so that smaller players also can make money. Then single price auction and multiple price auction, that also should be given here. Multiple price method. Okay, the auction will be price based using multiple price based. Bids for the auction should be submitted. Okay, so multiple price based means different companies, different institutions will quote different rates. Correct. Single price auction means all investors pay the price associated with this cutoff yield. So that means cutoff yield means what? Like say for example, this is RBI or the central bank, okay, of India. Now these all are the institutional investors. Institutional investors, 1, 2, 3, 4. Now this institutional investor is quoting 7, is quoting 6.9, so 6.95, 6.8. So RBI will take this as the cutoff. Okay, right, 6.8. But if this guy is not able to lend more, let's say RBI wants 2000 crore, this guy is able to give only let's say 1500 crores. So remaining 500 crores they are taking from this guy. So from him 500 crores at 6.9 percentage, and from him 1500 crore at 6.8 percentage. That is called multiple price. Single price means the cutoff is 6.8, right? So both will get 6.8 then. That is single price. Okay,
Can
whatever
you
is the cutoff.
explain this again? This one
Yeah,
more time.
single price means, now see, this guy says he is uh, single price means, acha, single price here what will happen, 6.8 and 6.9. So
There are
let's
four
say
different rates by different individuals.
the cutoff here, it will be for single price, it will be, yeah, now 6.8 percentage is not enough. He's getting only 1500 crores, whereas they wanted 2000 crores. So they are going for 6.9, right? So they will give 6.9 to this guy also, single, this and this is the cutoff.
Okay.
Why? Because if this guy is ready for 6.8, he is also ready for 6.9. That means, right, he is getting more
Yeah.
only, no?
Yes. Yes.
Is it
Yes.
okay? Single
Yes.
pricing. Multiple pricing means whatever price they quoted, that only. And this will be rejected. 6.95 or 7 will be rejected. Is it okay now?
Yes.
Okay. Then next one. Primary dealers. Primary dealer means when it is like wholesale business. Investment banks, this is government. Government cannot directly go to the public because they can go, but then it will be too much of time consuming for them. So what will they do? They will go to the investment bank. Investment bank will buy it on wholesale basis from the government, and then they will resell it back to the investors. Okay, they will resell it back to the investors. This is called what primary. This is called primary dealer. At this time, they are called as primary dealer.
Government is approaching the investment bank, and the IB is selling it to their like
Yeah,
clients.
so they will sell it on wholesale basis to the investment bank. Investment bank will buy those bonds and resell it back to the retail investors. So that time they act as the primary dealer. Okay. And then on the run, this is just a terminology. On the run means the latest bond is called as the on the run. Off the run, on the run. So the latest bond is called on the run bonds. Other bonds are called off the run bonds. Okay, that is just a phrase kind of thing. Fine, okay. Then, yeah, so from here all calculations. Reading 52. Okay. Okay, let's do this sum first. Uh, Okay, let's just do this one only. One by one we'll go. This is a 5-year bond. Okay,
We can
5-year
use the
bond, 10
CFO
percentage coupon.
function.
Huh? Huh?
We can use the CFO function in there.
CFO function.
Yeah, like
CFO as in cash flow function.
yeah, cash flow. For doing
Uh,
this,
yeah, you can use. You can use. Yeah, you may use. No. You can use that one also here. Yeah. Okay. But this one is better.
the
This is called
PMD.
TVM. TVM is
Yeah.
better. Yeah. Okay. See, 5-year 10% coupon annual pay bond for $100 of par value. The coupon will be paying 10%. 10. Yeah, because 10% of 100. So I'll write it down here. Shravani, when are you giving the exam?
Feb 26.
Okay. Feb. Okay. So 5-year bond. 5-year bond. 10 percentage coupon. Coupon is equal to 10 percentage annual pay bond. So 10 percentage per annum annually paid. Okay. Rate is always quoted as per annum only. If it is semi-annual, they will mention. Okay. For treasury bond, they will not mention. Okay. Treasury bonds is always semi-annual, that we have to understand. If they mention, good. If they don't mention also, we only have to understand that treasury bonds in US, they pay semi-annually. Face value IY. I will be using this word very often. IY means interest per year in the market. Okay. Interest per year in the market. That is how much? That is interest per year in the market, which is called as appropriate discount yield is 10 percentage. 10 percentage, which is a discount rate. Face value is 1000. No, not 1000, 100. Par value means face value. We have to calculate the present value. So how do you calculate? So first you draw the timeline. This is a 5-year bond. 1, 2, 3, 4, 5. Okay. So now 10 percentage. 10 percentage, okay, and 10 percentage. So 10 percentage of 100 is the coupon, which is what? 10. So this is the cash flow. And then you will get back the principal amount. So this is the cash flow, and we have to discount this because we have to calculate the present value. And present value is equal to what? Future value divided by 1 plus r raised to n. R raised to n. So this is, so when I'm standing here, this is my future value, first future value, divided by 1 plus R is the rate, discount rate, which is what? 10 percentage. 10 percentage raised to 1. So can you calculate this now? You know how to calculate, right? The calci. Shravani?
Nine 9.09.
Yeah, Shravani, you know how to calculate?
Yes, sir.
Okay, keep it in store 1. Okay. Then the second one,
8.2644.
yeah. So just I'll show here once. This is 1 plus 10 percentage for 2 years. 8 point, 8 point, what did you say?
26.
8.26.
26. So how to do in case, you don't know. So 1 plus 10, first you solve the denominator, okay? Solve from the ending, that is better for handling complicated sums later. So from the ending means 10 percentage plus 1 raised to 2. So 10 percentage, okay, then plus 1 equal to, which is 1.10, and raised to 2 equal to, then you inverse into 10 rupees, right? Numerator is 10. So 8.26, and keep it in store. This time it is 2. Okay. Then store 1 you have done. What is the third one? 1 plus 10
Third one
percentage
is
raised to 3.
7.51.
7.51.
Yeah.
So store that down as well. This one.
6.83.
This is 110. Okay, you should be careful.
Yeah. This one is 68.30.
Now you do recall 1, recall 2, recall 3, recall 4, recall 5.
Is 99.99.
Okay. Acha, this will be 100 only. This actually without calculating also we could have done. See, always whenever this coupon rate and IY are same, it will be priced at par only. Okay.
Yeah.
So if you want, this is the long cut method. Shortcut also we can cross check. This is the TVM function in the calci, right? Third row. In the calci third row, NIY, present value, payment, future value is mentioned, right? So first you type
Means
N. N is 5, number of periods of compounding is 5 times 1, 2, 3, 4, 5. So 5 you type and then type N. 5N. IY is 10 percentage, 10 percentage, but don't type percentage, type only 10, because the system knows that it is percentage. Present value we have to calculate, leave it blank. And then payment is 10. Payment is periodic amount. This is 10, 10, 10, 10, 10. And then future value is 100. Okay.
so, but
And then
it's coming to 98.2346.
no. Okay, I'll do this now. Click on compute and then present value. Okay. See, 5 years, so 5N,
Yeah.
10 IY. Present value you have to calculate. Payment is 10.
And
Then future value is 1000.
1,000 or 100?
Sorry, 100.
100.
Now compute
Yeah, it's
present value. 100 only, no? Minus 100.
okay. So I'm getting it as 98.23.
No, try now again.
Yeah, I'm trying it.
I'm getting -100 only.
100 only. Yeah, it will come to 100 always. In fact, there is no need to do. If I told na, that is the rule, that if present value, if coupon is equal to IY, it will come to the par value only.
It's again, sir, coming 98 minus 98.23.
Okay.
Like it should be 100, like when I was just as per the rule.
Yeah. Something you are doing wrong. You just
How do we clear it? It's second and FV, right?
see, even if you clear
No.
it, okay, you try clearing. See, this is
Second and
clear
FV,
TVM.
right?
So this you want to activate clear TVM. So second and FV, when you do this, clear TVM will get activated for the third row. Hmm. Hmm. Hello. Hello.
Yes, sir.
So I don't know if there's something wrong with my calci. Like in the soft copy, like in my phone, I'm getting it as minus 100,
Ah.
but in the calci, it's 98.23.
Again, is it in? No. Again, you are after doing second clear TVM also.
Yeah, yeah. And there's something. This star sign is there on the right corner, top right corner.
Okay. You just
Oh,
take a screenshot of that and send it to me.
yeah. I've sent it, sir.
Hmm. Star. Okay. Okay. So, but you in your calci it is coming correctly, is it?
Uh, no, in the calci it is wrong,
Hmm.
and on the soft copy it is correct.
Okay, let it be. Then
Mm.
tomorrow you just show it to me.
Yeah,
Okay.
yes.
You just t- note down this sum. Tomorrow you show it to me. So you do it in front of me tomorrow. Okay. Okay. So this is how we are supposed to calculate the present value. Then um, now this one, when the discount is 8%. So if the discount is 8, that means next sum. So next sum, 5-year maturity bond.
Yeah, so now
5-year
it's
maturity.
coming. Now it's coming.
Okay, coupon is 10%. Interest per year is 8%, and then future value or face value is 100. What is the present value? So now again, let's couple of times use the shortcut long cut method, then we will go for shortcut. Okay, I mean, couple of times let's use both, in fact. So what is the payment over here? 10, 10, 10, 10, 10, and then 100. Now 1 plus IY discount rate is 8% raised to 1. Just calculate this and keep it in store 1. Keep telling me the number.
9.25.
Second one,
It's 8.57.
hmm,
It's 7.93. 7.35.
hmm. This is 110.
Yeah. So 74.86.
Hmm. Shravani, are you speaking?
No, sir.
Okay.
So
How
it's
much is this?
107.98.
Yeah, 99107. That is fine. Now you use the shortcut method also and check. 5, IY is 8, payment is 10, future value is 100.
Yeah, it's the same.
Okay.
Uh, Actually, I had activated the P by Y option once. Like I was doing a
Okay.
amortization one thing. So and I had CY as 12. So I think it was because of that.
Yeah, C by Y should be 1.
Yeah. So now just now I checked it. And so
Okay, okay. Now next one, semi-annual. So semi-annual means what? So now you can see here when the interest rate went down, bond price went up. Remember that rule, inverse relationship. Interest rate came down from 10% to 8%. Now previously it was 10. Okay, now the price has gone up.
yeah.
So next one is semi-annual. Okay, semi-annual, it's a big one. We will not do this one. I'll take little smaller one. Okay. You may do this once you understand. You may take this as a homework. Okay, do this one at home for practice. But I'll give you now, we'll frame on our own little smaller sum. So let's say 2-year bond. Okay, here it is 5-year, that becomes too much. 2-year bond. Coupon is 5% per annum. 5% per annum. Paid semi-annually. Paid semi-annually. Coupon. Then IY is, let's say, what is the IY? They have 8%. Okay, 8% per annum. Uh, Future value is 100. What is the present value? So now this is for 2 years. Okay, 0, 1, 2. Now say paid semi-annually. So 0.5, 1.5. So 1.5, 1.5. Now, how much will, coupon is, a coupon I took 5% only. Coupon, let me take 10%. Okay. So now 10% means 10 rupees, but it will be paid semi. So that means how much will they pay every time? 10%.
5 and 5, right?
No, it will be
10, 10.
5 rupees, no? Because
Yeah,
10% means 10 rupees annually. But
yeah,
when they
like
are paying
5 and 5.
5, 5, 5, 5, and then face value.
Yeah,
This is the cash flow. Now I will discount this. No, this you need to pay attention. See, this is 8%. But then I am just half year away. So I should be discounting for half of 8%. So half once. Okay, so now again start from the ending. Do 8% divided by 2 plus 1 equal to. Because this is where it benefits if you
that will be
start from the ending.
1.04.
If you start from the ending. Otherwise, if you do 1 plus 8% divided by 2, you will get a wrong answer. You should do 8% divided by 2 plus 1 equal to and raised to 1. So it will be 5
1.04.
divided by 1.04.
Yeah, so it is 4.807. Like, so 4.81.
4.807. Then you keep it in store 1.
Okay.
Then next one, 1 plus 8%. Now because it is semi, I will keep doing divided by 2. Okay, so that it becomes 4%. This 4% 2 times from here, from here to here, and then again from here to here, 2 times. So
This
raised to 2. I will do raised to 2, 4%. So that comes to what? 5 divided by what is this?
5 divided by that is 1.0816.
And then entire value is
That is 4.622.
divided by 1 plus 8% divided by 2 raised to 3. So raised to 3, why? Because it is 3 times away. So 444 will 4% will happen 3 times.
This is, you want to know the denominator or the
Yeah,
final answer?
denominator. Yeah.
1.124864.
So 1, 2, and 3.
So it comes up to 4.444.
Okay. This will be 105 divided by this number.
Yeah, this is a big number. Look. 1.1698
1.1698.
5856. So yeah, the final is 89.7544.
89.7544.
44. And it is 103.6298. The final answer.
Okay, now you can cross check. This is the long cut way. Shortcut, you just cross check.
Yeah, it's the same. Like,
Yeah, what will be n?
and will be wait, how many is it? Four. Sorry.
Yeah, n will be 4. Okay, Shravani, have you
Yeah,
understood
and
n will be 4? Why n will be 4? Have you understood? It's a 2-year bond, but n will be 4. Shravani, have you understood this one? Why n will be 4? Can you hear Shravani? Okay, I think she's not able to hear. Just give me a minute. I'll call her up.
Oh, yes.
Yeah. Okay, Subhajit, I think she says like she can hear us, but then
Mm.
she is not able to reply. Some she is going to like restart. Do you want to take break now, or you
Yeah,
want to
yeah,
take
no
break
problem.
later on?
No issue.
You
Yeah.
can have your dinner now. You
Like
want
I
to wait?
already had it, but I'm okay with the break. Like, so,
Okay, you already had it. No, okay,
yeah.
then we'll just hold on. We'll just wait till she comes back.
Okay,
Like
okay, so,
2-3 minutes break. We'll just take. Okay,
yeah.
till she comes back. So I'll put a message that yeah, I'll put a message to her to inform her
She
that she's
joined.
back already.
Hello.
We can hear you now. Yeah.
Okay.
Okay, fine. So okay, then we'll continue only then. Hmm. Okay, so this will be n, and the n will be 4. Okay, reason being 4 number of times it is compounding. Okay, 1, 2, 3, 4. IY will be 8 divided by 2. Okay, because it is semi-annual. Okay, see, you don't try to count on your own, because this is 8 is an easy number, but if it is something like 3.75 and if you have to divide, then it will be difficult. So you just take whatever number given, divide by 2, because it is semi-annual, and then equal to, you click, let the system count. Present value you have to calculate. Payment is 10 rupees. No, not 10, 5. Every time 5. And then future value is 100. Okay, and when you compute present value, it will come to minus 103.62, this number. Okay, then next one, this is, so this is for 2 year I did. You please practice for this 5 year sum. Okay, semi-annual 5 year, it will be good practice for you. Then next one, calculating yield to maturity. So yield to maturity means here in this case IY we will calculate. Okay, rest of the data are given. So rest of the data they are saying, if the bond price is 105, what is the IY? So here N is 10. 10. Okay, yeah, I think they are continuing from this sum. Okay, Acha, they are continuing from this sum. So we have to then get this question. Rather than 10 year, the security will pay 5 each every 6 months, assuming an annual YTM of 8%. We need to discount the coupon payment at 4% per period, which results into, actually here present value is coming as 108, but then they are saying what if the present value is 105? Okay, present value is 105. This is minus, and n will be, this is for 5 years and semi-annually they are paying. Where is it given 5 years? That question actually comes from here. Anyways, we let it be then, doesn't matter. Suppose here itself, let's see. See, in this case, present value is what? 103.62, right? Now, in case if the present value is, say for example, 105, payment is 5, 100 is future value, n is 4. Calculate IY. Just calculate this one.
3.6343.
Hmm. 3.6343. Now multiply by 2 because it is semi-annual, so we have to make it annual.
7.2687.
This is the interest rates. Okay. So people normally make this mistake, okay? They don't multiply it. And this will be one of the option in the answer, A, B, C. And this will be the first option. So once you see this one, you will tick. You will think that this is the answer. But that's the trap. Okay, so you be careful with this one, okay? Then now coming to accrued interest, flat price and full price. Okay. Just go through this question. I'll just connect my charger in the meanwhile. Just go through this question. Hello, can you hear me?
Yes.
Yes, sir.
I'm not able to hear you. Just give me a minute. Let me reconnect again. I think the connection got loose. Just you be there. Hello?
Yes, sir.
Yeah. Okay, now accrued interest, right? So accrued interest. An investor buys a 4% annual pay bond. Okay, and pays its coupon on 15th. So annually, every 15th it pays. Uh, so 15th May to 15th May. Okay, 4% annual pay bond. The investor's order settles on August 10. So May, June, July, August. So let's say this is August. August 10. The investor's order. That means some buyer has bought. Calculate the accrued interest that is owed to the bond seller. So now imagine there is a buyer. Buyer is becoming the owner here. Now when buyer is becoming the owner here, okay. Now the question is calculate the accrued interest that is owed to the bond seller. Now you tell me when the next interest payment here on May 15 interest is paid for all the previous time. Okay. Now next interest payment will happen on May 15. But then in between August, assume that you are the seller, you have sold it, and the buyer becomes the owner on 10th August. Now from here on, the buyer is the owner. So when May 15 comes, company is paying interest to whom? Whom will the company pay interest? To the buyer or to the seller? You understood the question?
On May 15th, the interest is to be paid. Is it?
May 15, this May 15, they will pay to the new buyer or to the old seller?
Seller, right?
Seller?
Because the buyer is buying
No,
in
the
August 10.
record, on the record, buyer's name will reflect, right? When company will check, buyer's name will be reported, right? So
Yeah.
they will pay to the buyer only, and that too for the entire year they will pay.
Okay.
Okay, for the entire year they will pay. Now, if you are the seller, what will be your argument? You will be okay with it?
No, because May, June, July. So for he's buying it in August. So he's not holding it for the entire period.
So your argument will be what? That you deserve interest for this time period.
Yeah.
Okay. And but then the company is not going to listen to you. Company will say, I don't care for all these things. When I checked my record, I saw the buyer's name, I'm paying all to him. So company is not going to listen. So what you will do, because you know that you deserve, so you will calculate and you will add it to the price of the bond. Okay, so there is one price of the bond. There is one price that is called as clean price. Along with clean price, you will add accrued interest for this time period. And then it becomes dirty price. This is the formula. Dirty price is equal to clean price plus accrued interest. Okay. Now accrued interest only we have to calculate here. So accrued interest, how will I calculate? See, coupon rate is 4%. So 4% means 4%. So 4% is 4 by 100. 4% for how much? 100 rupees only. Now if nothing is mentioned, let's take 100. So 4% of 100, that comes to 4. That comes to 4. So now comes to 4. Now this is for the entire year. That means what? This is acha. How do I calculate? This is for the entire year. So let's say entire year is 365 days. Out of that, now I need to calculate the exact number of days for which I deserve. So from May 15, right? So in May, then how many days are left out? May 15 is gone. So May total has 31 days. So 16 days will be left out. Correct? 16 days total. May has 31 days, right? May, June. June has 30.
30 plus 31,
July has 31.
and then plus 9 days, right?
August will have 10 days.
But
August will have 10.
he's buying, like he's possessing it
Acha,
from
10th
10, like
onwards, na? Acha, 10th. 10th onwards, buyer is the owner. So August, no, it will be 10 only.
okay.
10. Let me see that one. Yeah, 10 only, correct. Okay, why
Why?
10? You know, why 10? Because 10 to 11 is one day. Okay, 10 to 11 is one day. So this is one day. So till 10th, it is the seller.
Okay.
Okay, 11th onwards, it is the buyer. Why? You know, because when we calculated, we didn't calculate May 15. We calculated May 16th onwards.
Right.
May 16th onwards. That day we left. So this is different ways to calculate. You know, what you said that is followed in UK. But, you know,
Okay.
in US, this is how it is followed, that we are calculating from the next day onwards. May
Okay.
16. Actually, if you include May 15, it will come to 17 days.
Hmm.
So here you did not include May 15. Similarly, buyer will not include August 10.
Okay. So it's 87 days in total.
Yeah, 87. So 4 is for 365. How much will it be for 87? Calculate this.
0.9534.
This is the accrued interest.
Okay.
Okay, 0.9534.
So 4 is the
0.9534.
percentage, right?
4 is the percentage. Now 4 percentage of 100. Our face value is also 100 only, no?
So
So
it
that
should be
becomes
like
4.
it is like 87 days out of 365 into 4, no?
Yeah, correct. That one only. 87 divided by 365 into 4. Okay, so 0.953, this one. Now there is one more way to calculate this accrued interest. Second method is called, this is called actual to actual. That means actual number of days in a year and actual number of days, 30, so 30, 31, so 30, all this actual we took. So actual to actual, actual to actual, okay, or actual to actual method. The next one is 30 by 360 day. 30 by 360 days method.
This was the actual one. What
Huh?
we did now. This is
What
the
we did is
actual.
actual. Actually, 31 days are there in July, so we took 31.
So
Actually,
now,
30 days are there in June, we took 30. Actually,
yeah.
365 days are there in a year, so we took all actual. Now, 30 by 360 days means some companies will say, like, I don't want to get into all these things. Why? Because to do all these things, your company's operations, machine should be good enough, because it should know which month is 30, which month is 31. Every leap year 28 days will change to 29 days for February, correct? It should know February 28. It will lead to more operational problems. Okay, so company will say, like, look, I will assume that every month has 30 and there are 12 months in a year, so that becomes what, 360. So I don't care whether it is February or June or July. For me, each month has 30 days. Simple. Let me focus on my work. I don't want to get into all these operations. This is what I'm going to follow. That way they will follow. Okay, 30 by 360 days method. I'll show this to you now, which companies are following like this. One or two examples I can show it to you. Okay, where you can find this. Okay, right now we'll just finish this, then I will show. 30 by 360 days method means what? Now I need to calculate here. So in a year, how many days are there for me now? 360 days. Okay, irrespective of the actual days. So in June, not June, May, right? May. So in May, how many days are there for me? 30 days. Out of that 30, actually it is 31, okay? But I will consider 30. 15 days are over. So remaining how many days are there?
15 days.
15. Okay. June, all 30 days.
So 85.
Yeah. July, all 30 days for me. Because I don't care if it is 31. I will take 30 only. July. August, it is 10 days. So 85. So 4 rupees is per annum. This is for 360 days. How much will it be? Will it be for 85? Just calculate it.
9 point, sorry, 0.9 444 like, it's recurring.
This one. Okay, this is how we are supposed to calculate. Okay.
So like here the
Now,
company is paying less, right? Like it is
yeah.
like it's a little like slight difference, but
Yes. Yes. Yeah. Okay. And this clean price is also called flat price. That we will see how to calculate that also. Dirty price is also called full price. Okay. Full price. Okay, now if you want to see this practically where they how it is or where, so you can just simply type Muthoot bond PDF. You should be able to get it. Prospectus. Go to the prospectus. Here, uh, thirty by 360 is not there. Actual slash actual. See, can you see here? Actual by actual.
Yes.
How do I make it bigger here? View. No, here there should be a way. No? This one. See, day count convention. It is called day count convention. Day count
yeah,
convention.
and see,
Actual
actual,
to actual. Okay. Otherwise, they would mention 30 by 360. Okay. Actual to actual. Okay. If you want to see the structure of various types of bond, Acha, I think I did not show that to you. I'll show you here. Practically, that all different types of bonds I was explaining, right? So I'll show that structure here. See, one bond also can issue various types of bond. I mean, one company. See, now this is Muthoot Finance because their job itself is to raise capital through bonds and then keep giving gold loan. So you come here, click on this issue structure. So this is the structure. You see how many varieties of bonds they are going to give now. Where is it? This one. I did not show this to you before, right? So see here, these are all various types of bonds they are issuing. Monthly, this is annually. So they are giving all varieties. Monthly being paid. Now we are seeing, right, semi-annually paid bond. So this is monthly being paid. Annually. Now what is this? They are not at all paying anything here. So that means what type of bond is this? This is zero coupon bond.
Zero coupon.
Okay, this is zero coupon bond. Now, and in this zero coupon bond, does that mean you are not going to get anything? No, you will get 8. You are getting 8%, but it gets accrued. See here, you are paying 1,000. They will pay 1088.228. Okay. So this is what is the time period here? Duration 400 days. This is 2 months. So let's check this one. Not 2 months, 24 months. No? So let's check this one. 24 months is easier to calculate whether it is matching or not. It means the rate. See, effective yield, coupon rate. Let's calculate. See, NIY, present value, payment, and then future value. So here, this is for 24 months. So I'll take this as 2 years. Okay. 2. IY we have to calculate. Present value is 1,000, and after 2 years they are going to pay how much? 1171.81. 1171.81. This is minus 1,000. Payment is 0. Calculate the IY now.
$8.2501.
Can you see here? 8.25.
Yeah.
Okay. So this is what you are going to get, but you will not get periodically. Your 1,000 rupees is becoming 1171, right, in 2 years. That means you are earning 8%. So they are giving all varieties of bonds at the same time, right? Whoever in whatever they are interested in, they can buy. You can check this also 60 months. That means 5 years, right? So check this one, 5 years, 1,000 you will pay, 0 payment. You'll get 1521.05. Calculate now.
8.74.
8.74. So here it is, 8.75. Okay. Then similarly, here also we can cross check. Actually, this number is wrong. You know, this effective yield is wrong. So this kind of mistakes all they can make. So I'll tell you what mistake they have made. See, they said, let's take this example, 24 months. They said coupon is 8.25% paid monthly. So effectively, its yield will be more than 8.25. Okay, so this is a wrong number, 8.25. I'll show it to you. Okay. This is 24 months, no? So 2,000 you will pay. Payment will be 24 months, right? So monthly. So this is monthly. So what will be 24, right? 24. 24 and will be 24 times, yeah. And 1,000 you are paying. And payment will be every time you are going to get how much? 8.25. So 8.25, this is for yearly divided by 12. How much is it coming to? 8.25 divided by 12. That you keep it as payment.
0.6875.
0.6875.
And
So the
then
payment one will be negative, right?
payment, we are
Outflow.
receiving the payment. No,
Okay.
I'm spending 1,000. So I will receive
Okay. Okay.
payment.
You
And this
multiply it by
future by
1,000, right? Like,
multiple.
is this percentage?
Acha, this is 1,000 rupees, na? So
Yeah,
it
this
should
is
be
Sure.
6.8, 6 point. So then it should be,
875.
yeah, 6.875.
So this is
Or I can write 82.5.
68.
I
So
will
it
get
will be 67,
6 point.
687.5, right?
No,
If you
6.87.
multiply by 1,000.
No. Payment I'm going to get monthly, right? 6.8. See, I'm going to get yearly 82.5.
but sir, that is 1,000, right? And
That's why I'm saying, na, for 1,000 it will be 82.5 per year.
okay. So
So
it is
divided by 12.
0.6875 percentage, right?
No.
Percentage
Okay.
only. That's why for 1,000
Into
it
So
will
then
be
it will be 68.75 if
yeah, sure. No, it's 6.875.
6.875. Correct
Yeah,
only.
yeah, 6.875.
See,
percentage will matter.
0.687 is
Yeah,
for
like that
100.
is 0.6875 and then percentage also.
Yeah, see, 0.687 is for 100. So for 1,000 it will be 6.875.
0.875.
And the future value
Is
is
1,000.
going to be 1,000 only, right? So now you calculate the IY, just calculate how much it is coming to.
N is 24. It is,
And then
yeah,
multiply by,
0.6875.
0.6875.
Yeah.
see, this is
Multiply by 12, right?
6.875. Wait. 6.875
Yeah,
again.
it's 8.25.
6.875 thousand. Whatever you got here,
8.25.
multiply by 12.
Yeah,
8
after
point,
multiplying 8.25.
it is coming to 8.25 only.
Yes.
Acha, 8.25. Yeah. Okay, 8.25. Fine. That is okay. See, if I calculate effective yield, the formula for effective yield is yearly I am getting um, 82.1 plus 8.25 percentage divided by 12 raised to 12 and then minus 1 into 100. Calculate this one. 8.25 percentage divided by 12 plus 1 equal to raised to 12 minus 1, and then multiply overall by 100.
It is like 53,000.
8.57.
Yeah, 8.57 percentage. This is the effective yield. Yeah, yeah, we should not do this way. This way we should do effective yield. So the effectively you are getting 8.57 actually. You can even use this in Calci also. You can check. See, I'll see. I'll tell you how to do. So here how to do. See, go to this icon V. Okay, can you see this icon V about 2? So you want to activate that one. So you do second and 2. Okay, done. Icon V, and you will
Can you
get norm.
repeat? Can you show it again? Icon.
Yeah,
Second,
you
yes,
want to
yes.
activate this icon V about 2. Icon V is there, right?
Yes, second and icon. Yeah,
Second and then 2. So you will
icon.
get icon V activated.
Yeah. So
Nominal is 8.25. 8.25. Only don't type percentage. 8.25. Percentage, the system knows that it is percentage, and then enter.
8.25. Enter. Yeah.
Okay. Downward arrow.
E.
Effective yield is what we have to
Effectively,
calculate. Let it be now. Effective yield is
Okay.
what we have to calculate. Again, you do downward arrow. C by Y is compounding per year. How many times? 12 times. Correct? Monthly.
Yeah.
Enter. Again, you do downward arrow. Norm is okay. Again, you do effective. See, only these 3 variables are there. So third variable is effective. Now you click on compute. See, 8.57. This
Yeah.
is the effective
8.5.
yield.
yes, sir,
This is the
8.5.
effective yield actually. Okay, so
Okay.
that means effectively you are earning 8.57 percentage. What they have mentioned is actually wrong. But this is why you need to be a financial literate person, because otherwise blindly if you go and give your money to a banker or anybody, this is what they will do. Okay, so this will happen, like you go to your bank, all they will do is they will do sales. So that means they will do what they have been told to do. They are not there to serve you. Correct? They are sitting there to do sales with you. So you only should take care of your money. Okay. So these all are wrong numbers. These all. I have seen like this before also. I don't know why they keep making these mistakes. Okay. Similarly, you can calculate here also. Now see, this is annual. Achha, annual is okay. Effective annual is fine. This is okay. Monthly means it will certainly go up. So for this one, if you do 8.7 percentage, see, uh, this is 8.75, right? For 560 months. Okay, monthly 8.75. So if it is 8.75, so I'll do second clear work. Okay, you have to, but there is one problem in this icon V. I'll tell you now. See, I have cleared it. Okay, second clear work. Norm is what? 8.75, correct? 8.75.
The CYY remains the same. It doesn't
Yeah,
get
yeah,
clear,
yeah,
right?
yeah, correct. This is norm. Enter. Okay, downward arrow. Effective, I will calculate at the end. C by Y. Acha, here it is good. In the actual calci,
It doesn't happen.
it doesn't change. Yeah, the whatever you clicked before, that only will come. Like I clicked 2, right? Semi-annual. So it will show as 2. So you have to manually change it again. Okay, now this is monthly, na? So I'll type 12. Enter. Then downward arrow, effective. Just come.
9.10.
Yeah.
This is
9.11.
9.11. So this is the effective yield. Whereas they are not changing only. So that is wrong. Okay. Okay, what else you can learn here? Uh, Secured, redeemable, non-convertible. So multiple features in one go. It is a non-convertible bond. It is a secured bond. It's a redeemable bond. That means it will have maturity period. Okay. Fine. If you want to cross check also, here also you may do 9.11. Just quickly do 8.75 percentage divided by 12 raised to 12 minus 1 into 100 you do, you will get that. How much you got? 9.11 you will get.
9.11. Yeah, it's
Check.
same. Yeah, same.
Okay. 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 The next one, we have done this, right? Accrued interest, flat price. Okay, now calculating full and flat price of the bond. Okay, full price means dirty price, flat is clean price. Okay, the 5% bond makes coupon payment on June 15 and December 15. So coupon payment date. So that means, what do you understand with this line? It is a semi-annual bond. Okay, June and 15 is what? 6 months gap. Semi they are paying. So June. So June 15 and then December 15. Okay, and then again June 15. And is trading with the YTM of 4%. The bond is purchased and will settle on August 21. So August 21 will come here, right? August 21. Okay. When there will be 4 coupons remaining. Here timeline you should draw properly. 4 coupons remaining. Okay, so I'll make this timeline little smaller. 4 coupon remaining. So from here, 4 coupon remaining means what? This is first one, December 15. Then June 15. Then December 15. And then June 15. So 4 coupon remaining. Okay, 1, 2, 3, 4. So don't keep in your mind that only December 15 has to be the ending date. Okay, 4 coupon remaining until maturity. Calculate the full price of the bond, accrued interest and the flat price of the bond. Okay, all we have to calculate. Full price, accrued interest and flat price of the bond using actual days. So they asked only for actual. We will calculate both. Okay, actual as well as 30 by 360. Okay, so YTM, and this is annual YTM 4%. Coupon is 5. That means 2.5, 2.5 they will pay semi. So here, so now here the problem is all for this time period now, right? Because here is the new buyer. Okay, so first of all we'll calculate accrued interest. That's what we have already done, right? So using, they said actual days, actual. So June to August. So first of all, this is what? This is out of, acha, we have to calculate this also, right? June. So total, how many days are there? June 15 means actually how many days? 15 days remaining. July means 31 days, 30 days. June, July. August is what? 31 days. September, no, June, August 21 only, right? 21. Okay. So, August 21. So this is the accrued interest. 3, 4, 5, 6, 66 days. And total number of days will be June, 15 days. July, July is 31 days, no? So mistake. June,
Yeah,
July,
it's
August.
31.
So this is 67. So this is July is 31. August
31.
is 31.
September is 30.
September 30. October is
October,
31.
31,
November
November is 30.
30.
December is 15 days. 15th only, okay? Now you add up all
December.
this.
It's June 15th, right?
No, till
Even
December
for
15th.
December, it's 15th.
Yeah, December 15th, na?
Okay.
Here, payment date. Now you add up all this. So 5, 6, 7, 8, 8, 9, 10, 13. So
Yeah, it's
1, 2,
183.
5, 183. So that means semi means 2.5. So 2.5 is for 183 days. What will it be for 67 days? Calculate.
0.9153.
0.9153.
53.
Okay. 0.9153. This is the accrued interest. Okay. Now what is the clean price? Okay, clean price and dirty price, how will I calculate? So NIY, present value, payment, future value. N will be, see, I'm going to calculate for this time period, June. So this is 1, 2, 3, 4. This time period, okay. June IY is 4%. So I will do 4 by 2 semi-annual. Present value is that's what we want to find out. Payment is 2.5, 5 by 2. You have to be careful for semi-annual bond, okay. Future value 100. Calculate the present value now.
101.93.
101.93.
90, so
How much?
903.
903. Okay. Okay. So, yeah, 101.903. Yeah. Now, I'll take this book answer 101.904. Okay, 4, 2.5,
So why did
101.
we take N as 4?
Because
Like after
4,
3, there's 8. Right?
1, 2, 3,
Okay.
4 times
Sorry.
compounding. Okay,
Like this is
fine.
semi-annual.
Yeah, semi.
Sorry, quarterly, right?
No, this is semi. Semi,
Oh,
no?
semi.
Semi. 4 times compounding, right?
Quarterly. Yeah.
Okay, so that's why N is 4.
Right.
Okay. So now I know I have understood that the price is 101.904 here. How do I drag this price to August 21? So how do I do? So it will compound 1 plus what is the YTM? YTM is 4%.
4%.
So, but it is semi. So YTM is 4% divided by 2. Okay. divided by 2. And that is for how many days? 67 out of 183 days.
Mhm.
So raised to 67 by 183. Just calculate this. This will be the price on August 21.
So 100.727.
100 and
No, so 1 minute.
this is already 101.904, no? So it will be more than that.
102.645.
102.645. So this is the price on August 21. Okay, how to calculate this? Whichever time period, wherever you are, you go to the last coupon and then you find out the present value for that coupon on that day, on that interest coupon payment date. And from there you compound it to 21st August.
So this
This is
here,
called, huh?
so this here 101.904. This is the full price, and if
No,
we
no, no.
hold it,
102.645. This is called full price.
okay.
This is also called
If we
dirty
hold it
price
from June 15 till this June 15.
to August 21. So on this August 21, this is the price, dirty price. And we know accrued interest also. Accrued interest is 0.9153.
Like
So
102.645 is the price on August 21.
21.
102.645 is the price on August 21.
August
Correct.
21.
And what is
Correct.
this price? 101.904
That
is
is
the
that is the
full
price
price, right?
on that is the price on June 15.
June 15.
June.
June 15's full price, but we don't want June 15's price. We want August 21st price.
So no, the price like which is, this 101.904, like this is the price if we hold it for like 2 years, right?
Correct, correct. If you hold it
Okay.
for 2 years, correct. Okay.
So like
But
I'm
now,
making profit here, right? On August 21. Like if
I
I
mean,
sell
it's
it.
not profit or loss because we don't. Profit or loss means what, you know? Profit is, uh, see, profit is, suppose, you know, if this price is one, it should be 102.645, imagine. But you sold for 105, then only it is your capital gain. Otherwise, it's normal only. Na? This is the price it should be, and you got that price.
Okay.
So now clean price, how will you calculate? So clean price is equal to full price or dirty price minus accrued interest. Okay, remember I said dirty price is equal to clean price plus accrued interest. Therefore, clean price is equal to dirty price minus accrued interest. Dirty price is 102.9645 minus accrued interest is 0.9153. This one. Calculate this.
101.7297. This is clean.
7297 is 73.
Yeah.
0.915. Okay, we have taken 0.913. That is okay. Is it understood? This one.
Yes.
Now the same sum, if I have to do using 30 by 360 method, okay, then how will I do? 30 by 360. So again, I'll draw the timeline. So this is June 15, December 15, June 15, December 15, June 15. So June 15, December 15, June 15, December 15, June 15. And we are standing here. August 21. 1, 2, 3, 4. Now the question is 30 by 360. So first let's calculate the accrued interest. Accrued interest. 30 by 360 method. (30/360). So this is, so for me each month has 30 days. Okay, so June 15 onwards, how many days are left out? 15. July, how many? 30. I don't care if it is even 31 actually. Okay, August, it is 21, so days will be 66, right? And total number of days is June is, from June 15 it will be 15, July will be 30, August will be 31st, September will be 30, October will be 31, November will be 30, December will be 15. Okay, December is 15. Now you add up all this. Sorry, this is 30 by 360, right? This is 30, this is 30, right? So now this is 0, 1 carry, 3, 6, 9, 12, 15, 16, 17, 18, 180. Is it okay? 180. Okay, so that means 2.5, right? Coupon 2.5. So 2.5 is for 180 days. How much will it be for 66? Calculate.
What is the total number? 180.
180 days.
180. Yeah, it's 0.9166. So 0.917.
0.91
66.
66. This is the accrued interest. Now we have to calculate the dirty price. So first we will calculate for this one. Yeah, dirty price is not going to change because only accrued interest calculation only will change. So it's the same thing I'm going to do. So like the way I did here, this all will be same. So finally I will get 102.645. So here one, not here, here 102 point. Okay, 1. Okay. 102.645. Yeah. So my clean price will be dirty price minus accrued interest. So dirty prices accrued interest is how much? 0.9166, right? This one.
So it's 101.7283.
Yeah. Earlier, what was the accrued interest? 0.9153. Yeah. 10. How much? 10. 1.
0.7283.
This is the clean price. Fine. Okay. The next one. Flat price is not the present value of the bond on its last coupon payment date. Yeah. So we should not think flat price as the present value. Okay. Yeah. Because
Flat price is the price that is like if you hold it for the entire period, right?
in fact, Flat price is not the present value of the bond on its last coupon date. What is this 1.904? What is that? This is the present value. Yeah. So present value is 101.904
Okay.
and clean price is 101.73. Okay. Both are different. Okay. Both are different. So 101.904, where is that one? 101.904. This is the present value, but then this is on the day of, this is the last coupon one. Interest accrued 102. Okay, 101. Yeah. Anyways, flat price, you cannot consider that as the present value. You have to calculate actually. This way you have to calculate what is the present value of the bond. Okay. Then, yeah, so from here on, even it will be more interesting and more learning one. But I think it might be too much for you now, right? Okay. It's almost 10:30 then. So we'll just stop now here then, okay?
Okay.
So, yeah. But all these I have actually already recorded and put up in the YouTube channel already. So in case, what I will do, I will just put that also in the group now. Just if you get time, you watch it. And then anyways, because if you watch and then if you come back to the session, you will probably understand even faster, better. In case if you get time, you watch that, okay? I will put all those now in the group. Okay? We'll stop now.
Thank you, sir.